Well, with me today is Grant Forster, the CEO of Principal Global Investors Australia. Grant, what are the key issues when it comes to funds management, and particularly around fees and returns?
It comes down to basic economics 101, supply and demand. There's a huge supply of cash globally, whether it be through QE in the US, hopefully coming to an end soon, or the relatively newer programs in Japan and Europe. We expect that there'll be lower yields for longer. Interest rates aren't really going anywhere in a hurry. What does this mean? For Australian investors who also have, through our great superannuation system, a lot of cash flows coming in each year, that money needs to be invested. Now, you can invest in passive-like index structures, and it's fine for those to be priced cheaply because it's just a replication structure. However, in order to find opportunities in a more cash or yield-constrained world, you have to look offshore and you have to look at different asset classes. Might be CMBS, might be things such as in the States where they actually have real estate funds which are totally related to technology, for example. So the sectors are deeper, the opportunities are broader. You need to pay for this. Those fees are going to be higher. There's more expertise involved, and they're capacity constrained in many instances, because we're not the only ones who are facing investment hurdles such as low cash. Our friends in Canada, our friends in Europe have the same issue. So if you're going to find those investments which we think will do better in the longer run, you simply have to pay for that. And I'm not sure that's always accepted by this market.
So there's a lot of global cash chasing yield. Everybody's looking offshore, and that requires a higher level of expertise to try and get those returns.
Well, that's right, and you've got to you have to look a little harder and deeper. And I'm encouraged by the superannuation industry, particularly some of the pension funds, adding investment professionals here, because I think that will give them that experience and wherewithal to be able to look further and into more diverse areas, and hopefully reward our Australian superannuants in the long run.
Sometimes our industry gets criticised for having fees that are ostensibly too high. Do you agree with that criticism or not?
I think the comments around fees are very generic and sometimes not with a lot of detail. I would argue that fees had room to come down as an overall bundled superannuation product. My Super has made tremendous inroads into this. So those fees have fallen and they're coming down. So investors will have a choice. On the pure investment management side, wholesale investment management if you like, our fees in Australia are at least as competitive as anywhere in the world. If you talk to any number of managers at the FSC conference, you will find that many of us don't even offer some of our product in this market because we're able to receive higher fees for capacity constrained, interesting, diversifying product offshore. So we've got to be careful that our superannuation investors, our mums and dads, are not potentially missing out on returns in this pure following of the lowest common fee denominator.
So it shouldn't always be a race to the bottom. It should be other factors in there, including obviously returns and value.
It's quite interesting. If you were to go in and meet with a US pension fund or a European pension fund, one of the earliest questions as a funds manager we will receive is, what are your net returns? What's your performance? In Australia, one of the earlier questions we often get is, what are your fees? I think that's an interesting dynamic. And I do want to say, I think the focus on fees is a very important part of the overall picture. So the work that My Super has done and other areas have done to bring down fees is right. It's My Super as well. So it all makes sense, but you've got to make sure the pendulum hasn't gone too far.
Do you think performance-based fees help or hinder?
I personally like performance-based fees. I think they're intuitive, they make sense, with the right parameters and guidelines so that you're not incenting managers in the last 3 months of a deal to take huge risk. And I know our pension funds don't set up their mandates like that. So I think it makes sense. Historically, when managers, I'm sure a lot of managers at the conference are happy to offer performance, but historically it's seen as an administrative burden and often is not taken up, even though the industry would be usually pretty happy with performance fees.
Mm-hmm. Global equities, pretty popular in this market. What's the outlook in your view?
I would argue not popular enough. If you look at returns over 1, 3, 5, 7 years, global equities, either hedged or unhedged, has been the place to be. Now, our proponents of Aussie equities will go back the prior 90 years and correctly argue that they've outperformed. And that's been right. And also our Australian equity proponents will probably say, well, 7 years of underperformance, maybe the time is right to get back in. I would argue that a lot of those 90 years were built on a lot of demands for commodities and resources, particularly in the last 30 years. We're now moving into a phase where productivity, it's coming from technology, it's coming from other areas. The demand for raw materials is possibly not going to grow as quickly as it has in the last 20 years. So I think also in the context of an ageing population and globally, it's time to look for healthcare, for biotech, for technology, you name it. Those are the fields you want to have a decent exposure to. You'll only get them offshore. And last time I looked, we had 4 banks at 30% of our index. So, I'm not sure that's right for big portions of our market to be in, but that's just a personal view.
We've just come back from Japan and seen the big pension funds there, the major one, the government's actually mandated that they actually increase their global equity strategy. So a lot of those countries are starting to look outward as well. It's an interesting development.
Yes, and the vast sort of liquidity coming out of that system into other markets goes with some of my earlier points around cash. There's a lot of it around. Yields will stay low. There's going to be demand for a lot of assets. I think in addition to that conversation, I think unhedged global equities over the next 5 years is also a good place to be. The Aussie dollar has fallen a lot, but if you're looking over 3 to 5 years, would you rather be unhedged or hedged in terms of the Aussie dollar? Well, I think global equities unhedged is a pretty good place to be, and I think I speak confidently that versus sort of a world index, even at 20 to 25% global equities, Australian investors are still very underweight.
Thank you very much.
Thank you.